JP Morgan is about to roll over a multi-billion-dollar option hedge to protect their bank. And this happens every quarter. 4 out of the last 5 quarters have been extremely bullish. It creates a big buying push in equities. This is a screaming red alert buy signal to get started with portfolios, builders strategies. We're now up 246% year to date in our high risk, high return strategy. And this is turning every $10,000 into $34,600. This is the current trade alert recommendation for $10,000. If you're on a new trial, this is what we'd recommend you put to work today. If you're an existing member, we'll look at the unit breakdown towards the end of the webinar. Currently, we're long UVXY. That's your stock crash insurance. This is 33 shares. Next play is Ethereum with the Grayscale Trust, ETHE, 165 shares. 22 shares of NRGU, that's your inflation hedge or interest rates going up hedge with 22 shares. And we've got a short-term play on natural gas with Boyle with 11 shares. So we'll go over this and more later in the presentation. If you would like a customized trade alert for more or less money, shoot an email to support@portfoliobuilder.io. And as long as you're on an active trial, we can go ahead and get you a customized screenshot. In general, we look at the Ethereum play as a very aggressive growth play in the technology sector. And then we're looking at value or the interest rate inflationary hedge as being long the top 10 US oil and gas companies. Combined, it's a very smart strategy that reduces volatility and has given our investors a huge return this year. All right, let's cover the big headlines. The new variant we've been telling you is extremely bullish. This little guy is something like 50 times more infectious, but 1/10 as deadly. So it's nature's natural medicine to potentially end all of this pandemic nonsense. This will be very, very bullish for the economy reopening and the reflation play to begin. Biden last week confirmed no new lockdowns or mandates. In fact, all they seem to be doing is trying to get this behind them. So they just cut the quarantine down in half. They've also given note that you can test positive for weeks after beating the sickness. So this is all very bullish for inflation and oil. Herd immunity could be here very soon. Prepare for the grand reopening. I believe we're going to see economies globally reopening rapidly in March. This is going to cause inflation to come roaring back. We'll see how the Fed responds to this. But there might just be enough uncertainty to slow their roll in terms of forward guidance on rate hikes, which will be problematic for markets. Now, I do believe Joe Manchin will come to terms with Schumer and make a deal. After all the theatrics in December, creating volatility in markets, we told you to ignore that because we already knew they were pushing this to beyond the holidays. Politicians like to have their time off, and they had already planned to shelf it till next year. So when Joe Manchin had come out saying he won't do the deal, that was no big surprise to us. Japan and China are printing money now. Last 2 days, China has injected tens of billions of dollars into their financial system. So as the US is likely to slow down quantitative easing and potentially end it and even go into a rate hike cycle, China is getting ready to unleash trillions in credit to bail out their real estate market. And this is all coordinated. These big countries take turns printing money, essentially. Exponential cases may slow down inflation and peak out the CPI in 90 days. That's really going to be critical. So I'm not saying the inflation is going to disappear, just that it's going to peak out and start to slow down, potentially in 90 days. If so, this will be extremely bullish and allow the central bank to not go into a rapid interest rate hike spree in 2022, which could very likely disrupt markets. So again, that's a bullish surprise that I'll be watching like a hawk to anticipate just how much problems we're going to achieve from rate hikes in 2022. Let's take a look at our track records. The safe growth strategy is up 26% year to date. It didn't get lucky betting in one asset. This is the return with a very highly diversified portfolio. You own a global stock market and you're hedged against all sorts of inflationary risks. So that's where we're currently recommending you place 70% of your capital. The high risk growth strategy is where we recommend 30% of your capital, currently having a 16% drawdown in December, but even with that, we're up 264% year to date. Typically, when we've had a drawdown, that's the very best time possible to get your money into the strategy because we usually outperform after drawdowns. This is the key macro to focus on in 2022. What if I told you this is just about all that really matters for predicting markets? Congress increased the debt ceiling by $2.5 trillion. This will let us grow from 29 trillion to over 31 trillion by 2023, quarter one. So it's a 16-month plan. Now, of course, if we go past the Build Back Better plan, they'll blow through that $2.5 trillion probably in 2022. Again, more debt is very bullish for stocks, commodities, and cryptos, and less debt would be deflationary, which would make us want to go long US Treasuries and the dollar. Now here's a look at the debt growth of the government, and note that in 2001, when we had a 2-year stock crash, the government actually tried to balance the budget. That was a disaster for markets. They quickly reversed that course, and you can see in general, we've been on a trend of growing debt at faster and faster pace. And the US is really trapped until the inflation becomes unbearable and uncontrollable. This is the trend you need to bet on. The government's going to borrow more money than it makes and shove it into the economy to keep financial markets as bubbled up as possible. So now all they really need to do, as far as we're concerned, is agree on how to spend it. I don't really care how they spend it. What's important is they're going to inject $2 trillion plus into the US economy, which will flow into the global economy. We'll look at that trade balance, just hit a new record deficit, which again, we were predicting. And that's going to, again, make inflationary assets go up. And then on top of that, we've got corporations. Last year raised, I just read this, $12 trillion. US stocks are already announcing $1 trillion plus in corporate stock buybacks. So while you hear CEOs are cashing out at record pace, just remember they were cashing out at record pace every single year for the last decade. And meanwhile, the corporations are gobbling up those cells and essentially decreasing the supply of stocks. So we got the government flooding the economy with money, and we've got corporations literally sitting there burning the outstanding shares. So there's less and less available, which makes their earnings per share go up, even if the earnings are flat. Meanwhile, China is now bailing out their real estate market and economy after taking a year to essentially try to redistribute wealth. And very interesting things happening with lockdowns. We'll look at the news feed out of China. But in general, they have officially begun to cut interest rates and print hundreds of billions of dollars into their economy. Very bullish. Turkey has a bailout strategy. They got a ton of US dollars sent in. They've guaranteed Forex losses to locals. Now we are seeing that Turkish Lira start to fall, and their 10-year is now paying out 23% a year. So this is probably one of the more worrisome risks we can look at in the market, which I'm watching all day, every day for us. So far, nothing to freak out about. But they did get a bailout, and that did mark the exact day where the markets began to rebound after having contracted. So it looks like that was very, very important to stop the pain. But we are starting to see that pain start to come back. So we'll cover that. Right now, there's a very low chance of labor growth or rising rates. We'll cover that. That's going to be our signal to get more in the defensive side with our value assets like energy companies and banks, and start to pull off profits on our tech growth plays, which would be the NASDAQ, Bitcoin, and Ethereum. So again, I'm expecting that risk to really begin to develop in late February, early March. And this will be with the new variant essentially working its way through global economies and dying down probably by the end of January globally. And then to see the Build Back Better bill pass. Janet Yellen's going to pump tons of debt issuance into the market to refill the Treasury coffer up to about 800 billion, currently at 200 billion. And then we're going to have jobs come back online. So all of this is going to be a huge push to rotate money out of growth stocks into value. So if we look at it, countries globally are debased currencies. There's just no way around it. So cash is trash as long as this is going to be the policy of governments globally. And there really doesn't seem to be any change in plans to create surpluses at the government level. Blasphemy to even discuss that. And now, because the inflation is ripping higher at above 5%, with bonds trading below 2%, these are negative real rates. This is typically a very bad period to own bonds. We now have 300 trillion in global debt, and this is driven these rates so low that they are trading at negative real rates globally on any kind of bond you can possibly imagine, whether it's a junk bond, a government bond. I guess the only bond that possibly is positive is the Turkish Lira, which is going into hyperinflation. So investors really have no logical option of where to invest money. Now, typically when the US goes from quantitative easing to a tightening cycle, you tend to see bonds outperform stocks. But again, if we really look at the big picture, ask yourself, is the government going to balance its budget? And is inflation going to come back down below 2% where bonds currently trade? And I think the answer to that is no on both accounts. So you really have no smart place to hide your wealth right now. We have stocks, we have cryptocurrencies, and we have commodities likely to melt up until an alternative investment becomes more attractive. And I'm going to tell you what, the attractive investment will be when bonds correct and get their interest rate somewhere above the inflation rate. And that's likely to occur over the next several years. In fact, I believe it's going to begin to occur around March of next year. And so what's going to really drive this will be a strong labor market recovery. We have 11 million jobs begging to get filled, and we have rising wages. We have rising rent, and we have a Federal Reserve that's really stuck. If they try to stop the inflation, they will crash the economy. So I think they're going to let it run hot and do as much bluffing as possible that they're going to become hawkish. Now, with that said, if the producer price index and CPI don't slow down and top out in 90 days, I think the markets are finally going to react to out of control inflation. Go back to their history books and look at what happened to the markets when Paul Volcker had to fight inflation through the 70s. Now, again, I don't think we're going to have that uncontrollable decade of inflation. We'll look at that. My current assumption is inflation will peak out in about 90 days, and the Fed will be reluctant to get too aggressive with hawkish policy due to midterms coming in next year. But again, if this PPI breaks above 10, CPI goes above 7, and it keeps printing higher month after month, investors be warned, this will be problematic. So it's critical that everyone join our Monday, Wednesday, Friday webinar to be ready for the trade alert. We're going to be watching this critical data as it comes in and reviewing it over and over and over again so that you know what's coming and how to respond. In general, if we think the central bank's going to have to fight inflation and will actually do what it takes, it's quite likely going to crash global stock markets by hiking interest rates. And so again, if anything does go haywire, the current bet to make a lot of money is to own UVXY. This position generated a 1,000% return in March when we had a 30% decline in a month. So a 10% position doubled you up regardless of what happened to the other 90% of your portfolio. And the market's gone straight up since then because, again, the government and central bank have made alternative investments a bad bet. Cash is trash, bonds are garbage until they stop printing so much money and until yields on bonds are above the CPI. This trend is quite likely going to continue. So let's take a look at what we're recommending. 70% of your money in the safe growth strategy. That's a global stock portfolio that's hedged against all sort of inflationary plays. And then a 30% position in the high risk growth strategy, where we're betting big on Ethereum through the Grayscale Trust ETHE as the best growth opportunity for this decade. Now, big picture, what I'm expecting is a slow but steady rotation to be less concentrated in growth stocks and more money bringing up the valuations in banks and energy companies as we get this world back on track. And so I just want to point out in 2003 to 2008, as interest rates rose all the way to the top until things collapsed, your energy sector delivered a 300% return. With the play we're doing in our GU, that would have been a 900% return. Okay, we go crash the global economy, bail out the banks, and repeat the same strategy. 2008 to 2015, interest rates rise all the way, and you get another 300% return in energy. Again, your NRGU would have potentially gone up 900% plus. Now, in 2016, we started to hike interest rates as a populist president came in and tried to start messing around with global trade policy. And boy, oh boy, that energy sector tanked all the way down till the global lockdown. Oil went negative. What a wild time to be alive. But now we're back to the same habits. We're now doubling down on deficit spending and suppressing interest rates on bonds. So it's a perfect setup to repeat another 5-year cycle of interest rates rising and an overall growth to value rotation. Last time we did pass massive stimulus and thought we were going to get the economy back online was coming out of 2021. We had the warp speed and all that hype, passed $3 trillion in spending between December with Trump, $1 trillion, $2 trillion with Biden. Interest rates went rocketing up, expecting a inflationary reflation impulse. Energy went rocketing up, and once those interest rates rose too quickly, both Bitcoin and the NASDAQ crashed right around my birthday, funny enough, around February 16th. And you can see the yellow line went straight up. That's the bond market crashing. And that's what we're worried is going to potentially happen in general over the next 5 years, that interest rates need to go up and go closer to the true inflation. So that's what we're preparing for, as we're likely going to pass this Build Back Better plan early next year. Now, note, the recovery didn't happen. The job market was very poor. The labor force participation rate is still 3% below where it was pre-lockdown. And we had all sorts of problems, especially in Asia, with the sickness spreading and creating supply chain problems and lockdowns. And that's still there. We'll look at some crazy photos from China in my Twitter feed. But they have locked down a 13 million person city, and they're not even allowed to get food for the next 7 days. So if they continue that policy and all of China locks down, something to be on the lookout for. But in general, the recovery was not strong last year. This is a new year to give it another shot. And you can see those interest rates came down. The energy sector relatively traded flat during that span, and the tech stocks went rocketing right back up. So we'll take a look at where those charts look like today and what we're forecasting for 2022. Now, if you don't want to miss our next trade alert, please call John right now at 505-610-1334. He can give you a customized trade alert and get your portfolio ready for the next big leg higher, which I believe will begin on Friday due to JP Morgan having to roll over its massive hedge. All right, let's just take a look at the track records. The safe growth strategy is up 26% year to date, down 2% in December. We had a drawdown of up to 7.5%, I believe. So we've cut that down by not changing anything. As you know, we don't do a whole lot of trading unless the big picture has dramatically changed. Now, the high risk strategy, I just want to point out, we had a drawdown of 10% in March. In April, we delivered a 28% return. In May, a 19% drawdown, but over the next 3 months, we picked up a 28% return. So the bigger the drawdown tends to signal the better the returns coming ahead. So I'd really recommend you get started. Now, if you did 70% in the safe growth and 30% in the high risk, you've doubled your money year to date, and your greatest drawdowns were in March and May of 8% and 9%. Okay, very good. Now, again, when you do upgrade, you'll gain access to the safe growth portfolio, which you don't have on the free trial. You're going to get our turnkey software, which allows you to punch in how much money you want to invest. Let's say it's $100,000. You hit calculate. It's going to automatically calculate the exact amount of each ETF to purchase. All of our members are building out units. These units are comprised of a basket of shares in a very specific ratio. So let's just look at what the $30,000 high risk strategy looks like. Over in this right area, you can see the ratio for one unit is 3 shares of UVXY, 15 shares of ETHE, 2 shares of NRGU, and 1 share of BOIL. So all this is doing is taking 30,000, dividing it by the unit cost, and then multiplying it by the ratio and printing out exactly how many shares you should purchase. Now your membership will remember exactly what you've inputted, so you can go back and look at it at any time. Okay, very good. So let's get into today's news and data. Okay, first of all, the best indicator for interest rate risk, in my opinion today, is the reverse repo facility. This is where banks are going to the Federal Reserve and wanting to borrow their debts instruments so that they can collect safe interest to pay deposits on banks. Now, as money leaves the banking system, the banks are going to have less demand for these bonds, and we're going to see this reverse repo fall. So you should actually think of this as a kind of a buffer for quantitative easing. As we begin to end QE, which will likely stop in March, this is the buffer that's protecting markets. As this drops below $1 trillion and probably below 700 billion, we're going to want to take profits on our tech position and crypto positions, reduce the size, I'm not saying completely exit, and get more defensive against money rotating into interest rates rising, which would be banks and energy. European index also works very well for that. Okay, so very good. This is still at a very elevated level, signaling that we don't need to worry about our tech position or Bitcoin position. Okay, in this chart, we're trying to predict whether or not there's going to be a lockdown that could affect the price of oil and the obviously the interest rates. We've been now anticipating that there won't be lockdowns, and that does seem to be the case. Sure, we're seeing all sorts of little restrictions happening here and there, but in the US, it looks like this will be completely avoided. So very bullish to get in early on oil. Okay, now here's where we're looking at interest rates in yellow, banks in red, energy in green, and tech in the candlestick. And they've been trading very correlated lately, which is odd, and why I was saying this was very likely just manipulated market behavior. What do we anticipate coming up next? Again, interest rates rising, probably aggressively starting in March. So we're positioned perfectly for that in all portfolios. Here's emerging markets, which has a third of it in China, but it also gives you exposure to South Korea, Taiwan, India, Russia, all sorts of countries, Vietnam. And again, as interest rates fell, so did emerging markets. We can see the pain was primarily here in China. And so we're waiting to see if they're going to start to aggressively bail out China and reflate their stock market. So far, not yet. We have interest rates now beginning to jump, signaling that perhaps we're about to see that big rebound in emerging markets. And in the safe growth strategy, we've been adding to that over the last month. With, to be clear, only one trade alert did that. Meanwhile, over in the Russell 2000, it's hanging in there in these this critical range, bounced off this low right here, and really not giving us a signal up or down. I believe we need to pass the Build Back Better bill for the Russell 2000 to break to a new high. But it's been range bound since February. Also not liking these interest rates falling, but surprisingly being very strong. So from that regard, impressed with the IWM performance with interest rates falling. Now, when it was rising rapidly, you can see so were interest rates. So it's a reflation play. This is Stanley Druckenmiller's famous indicator to predict markets. So far not giving us a signal. Now, the European index we play is EFO. Very similar pattern as the Russell 2000, also hanging in there, being very strong with interest rates falling. And again, we believe interest rates need to rise quite substantially to go above inflation. Now, likely what's going to happen is the rates will rise and inflation will come down and meet. And I believe the meeting point will be around 3% on that 30-year as the maximum interest rate financial markets can sustain. Okay, here is that Turkish Lira collapsing, going up, getting bailed out, and now starting to sell off again. So hopefully it stabilizes. This is definitely something to keep a very close eye on. Now, what we're going to look at is the dollar index, which is the dollar against the euro primarily. And I want to note, one of our best months of this entire year was the dollar falling from 94 to only 93. We racked up massive gains. Since then, the dollar has jumped to a new level and has been trading sideways. Our portfolio is really positioned for the dollar to fall. And I do believe after we pass the Build Back Better plan and China begins to pump money into their economy, that we're going to see this dollar fall towards 90 in the next year. And that's going to be the signal to take massive profits on our commodities and our cryptocurrencies. I believe are going to see substantial returns during that period. Now, Jeffrey Gundlach, the bond king billionaire of Double Line, is actually predicting that over the course of time, we're going to see the dollar index fall towards 70 And so we have seen those valuations in the dollar against the euro back in the 2002 to 2008 period, which is exactly where interest rates rose, emerging markets kicked ass, and that's exactly how we're positioned. Interest rates rising, and we're betting on a huge play on emerging markets, which I'm gonna get more and more aggressive into as soon as we see darn Alibaba stop selling off, which we'll look at in a minute. But yeah, just extreme outperformance in emerging markets during this exact period. All right, next chart is the lumber futures. Can you predict everything through lumber futures? I was not listening to lumber futures, even though we watched it daily during the summer months. Kept us in our oil play, and lumber futures predicted an oil crash, interest rate crash. We overlooked it, or I overlooked it, and we could have had a better return over the summer had I not. Today, the lumber futures have begun their new trend higher. If the lumber futures are predictive, the inflation is not dead, oil's going much higher, copper's going much higher, and our natural gas position's about to go much higher, as well as interest rates. So we're perfectly positioned for what's coming next if these lumber futures are correct. It's a small market, but it's been very predictive year to date. Okay, some of the companies that have been holding up the entire market are notably NVIDIA, now trading at 35 times sales. Tesla, I don't even know what multiple it's at, something absurd. Apple has grown massively, and Microsoft. So these are the leaders of the global market that are keeping everything up, keeping a close eye on all four for any significant crash to predict potential volatility. And so far, nothing to worry about. And again, our signal to, and again, they're all tech companies as well. So this is telling us to stay long our tech positions, which would include Ethereum and Bitcoin. I know a lot of you guys betting big on that asset class. This is telling us to stay long. All signals are telling us no reason to sell right now. Now we are starting to see some money flow into non-tech giants. And so I'm keeping a look at the S&P 500's leaders that are non-tech and looking where money is flowing into. And so in the last 3 months, we've seen a lot of money flow into Home Depot, United Health, Johnson & Johnson, Procter & Gamble, and Bank of America. So that UPRO, which plays the SPY, does all of this for us. We're just looking at the flows of capital and that growth to value rotation trend. All right, over in Asia, we're looking at Taiwan Semiconductors in the candlestick, not budging. This is probably the most important company in the world, and China wants it. So this could very well likely be the next big war in the next decade or two. I don't think we're going to see it in the next 4 years, to be clear. But there's a rising feud between Taiwan, China, and it's one of the main reasons is that company right there. Now, Tencent and Alibaba are two companies out of China that I'm watching to predict a bottom and potentially rotate even more money into emerging markets. So far, Alibaba just cannot get a bid. So we're keeping a close eye on it to try to time a signal. Also, if we saw Alibaba fall further, I would be very concerned because it's already trading at a 50% haircut today. In fact, let's see if I can find an even bigger drawdown from peak. 57% drawdown from peak. Our European index has small positions spread out over many companies. There's no big leader like there is in the US with Microsoft and Apple. But their company, that whole index is doing very well considering the interest rates have been falling. So again, I believe that index is going to do very well for us. Now in this chart, we're looking at Exxon. This is the biggest US oil company and part of NRGU. And timing wise to sell NRGU, looking for two things: either the dollar hits that 91 to 89 level against the euro, or Exxon breaks above 90. And I think it's going to go to new highs, to be clear. So we'll start pulling profits as it gets to these higher valuations. In general, what I see is a growing demand for oil for the next decade. And this current administration is making it awful difficult for anyone to expand their oil business. So the big boys are set up and they essentially have a monopoly on the oil market for the foreseeable future. And the demand for oil is going to drive that price higher. So this is likely going to create the most profitable years for big oil in their entire history. And also this whole demand for clean energy is going to require massive amounts of oil just to go get all the copper and nickel and lithium that they're going to need to pull this off. So there's just no reason to believe this play will not repeat like it's done in the last two cycles. And the relative positioning in energy compared to tech is at an all-time historical low. Potentially this goes way higher than 100. If so, NRGU could be trading over 1,000 once we hit that point. All right, in this chart, we're looking at interest rates in oil, and we can see they have become in disagreement since May. Now we know there's artificial demand for bonds due to governments printing money and people putting it in bank accounts. This is forcing banks to buy debt to service deposits. Now, do we think bank deposits are going to grow as the economy reopens and fiscal starts to slow down? Or do we think bank deposits are going to deplete as people have to go back to work and start spending money in the economy? As you know, I believe interest rates are going higher, as is the price of oil. We've also had central banks buying their own debt to suppress these interest rates. So very, very interesting time period coming up. Here's copper. If China is about to print trillions and try to put their economy back on steroids to avoid a crash, copper is likely going much higher. So that's what I'm currently believing is about to occur, which would drive interest rates higher. Now, the Baltic Dry Index is another great way to predict inflation. It's crashing, but it's lagging those lumber futures. So we'll keep a close eye on it. If we zoom out, the highest price pre-lockdown was 2,400. It zoomed all the way up to 5,600, has crashed dramatically. I think this is going to bottom out and go back up. If not, this would be in disagreement with all of our predictions on inflation and that lumber futures trying to predict the market. So let's keep a close eye on this bottoming out. Now, this is some good news for how we're positioned. We're really positioned for a steepening of the yield curve. What's been happening this year has been a flattening. So in general, what we want to see is the 2-year to stop going up so darn fast and for the 30-year to go up. And so if I zoom out a little bit, we can see for much of this year, we've had the 2-year going parabolic to the upside. This is what's making everyone think the Federal Reserve will hike interest rates. So the 2-year has gone up 381% since the summer, but the 30-year is down 10%. So that's the flattening of the yield curve. That's basically predicting inflation is going to spoil all the fun, cause a Fed policy mistake, and crash the economy. So we're not positioned for that currently. What we're positioned for is for the 2-year to slow its roll and for the 30-year to rise. And so that's just now starting to occur. We're seeing that 30-year is up 10% and the 2 years only up 21% in this time period. So starting to occur, but that 2 year is still out of control. Also, the Turkish 10-year continues to rise rapidly. Another just topic to focus on in the bond market. Okay, we're starting to see a little bit of a sell-off here in the TLT today, which represents that 30-year, 20-year bonds. In general, if any of these bond markets are crashing, that's when we're going to get worried about stocks, because it means the credit flowing to the US government or the stock market is going to get more expensive. And we understand they need this debt to keep the party rolling. So that's my main fear for markets, are bonds becoming attractive by selling off and getting closer to a real return on capital compared to inflation. Until that happens, the stocks, commodities, and cryptocurrencies look extremely attractive. I'm going to go ahead and throw Tesla on here. And hide Bitcoin. Actually, let's hide Bitcoin. So this has not been a perfect correlation, but it's been pretty close. So what we're looking at is, I think I got the wrong one, sorry. There we go. These two have been not trading exactly the same, but pretty darn close. And so we have Tesla potentially predicting that Ethereum is about to bounce higher. We've seen this Ethereum bouncing up and bouncing down. Typically, the trend has been people in overnight markets are dumping crypto. I think this is due to big losses out of Asia and Turkey in the real estate market for bond holders, and for anyone involved in any investment in Turkey. So I think that's what's causing forced selling. Then during the daytime, we've had US whales gobbling up these cryptos. So at this point, I believe we're quite likely going to see Ethereum rally into next week, potentially correlated to the option activity on Friday with JP Morgan. This chart, we're looking at gold versus silver, and this is quite a discrepancy now. If we zoom out a little bit, we can see this is potentially a great scenario for silver when it becomes so cheap relative to gold and we enter a stagflation type of environment. Silver's done very well. So keeping a close eye on it, and considering adding to our gold position when the right time, or excuse me, our silver position for the safe growth strategy when that time comes. This chart, we're looking at our deflationary plays. If we really thought the Fed was going to have to fight inflation and do whatever it takes to accomplish that goal, even if it meant sacrificing the stock market, which would essentially be the PPI and CPI doesn't slow down by March. So we don't need it to crash. We just need it to stop going up. If it doesn't stop going up by March, the Fed very well may likely have no choice. And the plays first would be the UVXY going up massively. After that, we could look at a longer term position in the dollar and treasuries until we think they're done tightening. But right now, I don't like anything except UVXY to hedge portfolios. I believe the dollar is going to come back down from that 96 level to the 90 level. And I believe the treasury market has a good deal of pain before it can become attractive. I believe that CPI is going to head towards 3 and interest rates are going to head towards 3. And then that's when we might get super aggressive in bonds. In fact, I'll get you into bonds once we break beyond 2.4 and build into it as we approach 3 on that 30-year. Currently, it's at 1.9, so we're nowhere near there. All right, in this chart, we're looking at all sorts of inflationary bets. KRBN is the carbon credits. We're not in that play currently. Up 29%. I'm worried the Democrats are going to lose the House and Senate in the midterms, and that this whole climate change agenda is going to not be such a big thing. So not betting on that for our clients currently. Corn could be a good play next year, up 12%. DBA is a food ETN, more diversified, big one, up 7%. Cow would be a bet on the cost of meat going up 5%. COPEX would be for copper. I believe that's a good play. We're using REMX currently, a little more aggressive with lithium and cobalt, which are in high demand for electric vehicles and iPhones. So think of Tesla and Apple. Uranium, I believe, will be a good play for the next decade. So we're currently in uranium. We're out of tan. Solar, again, might be where we rotate out of boil into tan. MJ, we sat on all year and it just got decimated. It was a small position. Still got it on the radar. The fundamentals for those companies are getting better by the day. They're just not getting the hype. We really want interest rates to rise and the inflation to come back in terms of interest rates going up for MJ most likely. But we're out of that, just have it on the watch list. And again, I think we have a great setup for natural gas to go up and sell around February, and then look at the next inflationary play, which will likely be either a food play or go back to tan. So we'll keep a close look at that once we sell Boyle. Here's NRGU. And again, when we look at Exxon, if Exxon's going to double, then this one could triple. So that would put us above 450. So that's probably where I see us taking some huge profits on NRGU. Meanwhile, the Chinese yuan continues to strengthen. China's economy is very strong. Here's a look at their currency. If this is going down, it's outperforming the dollar. So we've got the dollar going up and the Chinese yuan going up. So very, very interesting there. But as far as China's real estate market collapsing and creating systemic risk through global markets, we're just not seeing it. We saw them attack their tech giants on purpose. We've seen them pop the education market. We've seen them crack down on video games, which explains Tencent's pullback. They've let bonds default to foreign investors. All of this, and their currency is rock solid. So as is their manufacturing sector. So once we look at exports, imports, they just hit a record high. So I think emerging markets has a really nice setup going into 2022. Okay, in the crypto world, big news is Ethereum is entering the merge stage where they're going to move into proof of stake and get out of proof of work. It'll be fascinating to see what impact that has on its competitions, which are already in proof of stake, which are Solana, Cardano, Polkadot, and Avalanche, as well as Binance. So exciting times coming up for Ethereum. Right now, to transfer Ethereum's ridiculously expensive. To do a smart contract's ridiculously expensive. So they're getting ready to reduce the technology advantage of the competitors below. And it'll be fascinating to see how that plays out next year. Very likely we could see Ethereum hit a top before the Fed does have to get aggressive with rate hikes, I believe in the $8,000 to $12,000 range. So very, very bullish on that asset. You hedge your Ethereum by owning Bitcoin, and you also hedge your Ethereum by owning the competitors that threaten its technology advantage. So again, those are Solana, Cardano, and we're not doing that at Portfolio Builder. I'm just making you aware of who the threats are and what the big changes coming in are. So this merge could be happening in March, a very bullish catalyst coming up. for ETHE. Okay, gold to copper ratio is currently flat, not predicting up or down. This predicts interest rates very reliably. If we're going to have a 2002 to 2007 reflation play that's working, then we want to be betting big on copper, not gold. As you can see, that massive outperformance from 2002 to 2007. At this point, that's what I believe is going to repeat. And that's because of the level of inflation and all the tailwinds are going to continue to keep inflation hot, which again are going to be rent is going to rise to catch up to new mortgage prices, wage pressures going up, and employers are having a hard time filling the jobs. So all of the wage pressures coming in now. In this chart, we're looking at the CME group, and what we can see is the probabilities for interest rates in June. And right now, this is predicting that we're going to potentially have 2 rate hikes by next June. Now, last time we did rate hikes, things didn't start to collapse for 2 years of rate hikes, but the markets are substantially more interest rate sensitive. So you're going to see a lot of focus in predicting the Federal Reserve and interest rates over the next 12 months out of Portfolio Builder. And so I believe we're going to peak out inflation in 90 days, and the Fed's going to be more dovish than the market's expecting. So that's currently what we're positioned. Now, instead of looking at the interest rates from last year, before stimulus and after stimulus, which we typically do, today I chose to look at the yield curve over September, October, November. And what I want you to note is the further we go back, the lower the front end and the higher the long end. And what we've seen over the last 3 months is the 2-year go up and the 30-year go down. That's the yield curve flattening. We're really not positioned for that trend to continue. We're positioned for the 2-year to stabilize and the long end to go up. Okay, so it's a steepening of the yield curve. On the Vix Futures, this is where we can predict market risks, or at least where participants are hedging. And the greatest amount of hedgings in January, then February. What we're focused on is the change of the price from month to month. The bigger the jump, the more hedge that's occurring. Let's see, why are we having drawdown? Well, you know, the market doesn't go straight up. And all I can say is we're looking 3 to 6 months for market calls and positioning for that. And we don't really budge. And the profits keep rolling in as long as you don't, you know, what you don't want to do is sell low and buy high. That's the primary mistake beginners typically make. So as long as you don't do that, just follow the trading plan, relax, and let the macro play out. Okay, so what could happen in January? They need to pass this Build Back Better bill for sure by, I would say, late January, early February, or markets very well may likely get upset. Politicians are on break, so there's no headlines with this. We can worry about this next month, and we look forward to JP Morgan doing this massive options trade, which is likely going to be very bullish going into next week. Okay, so to predict the recovery, we really want to predict when this new variant is going to slow down new cases. So we're looking at South Africa, and it was about 15 days to the top, and now it's crashing right back down. Now, obviously, the US is a much bigger geographic area, so it may not be exactly the same. In the UK, we're watching. It's having a similar, I believe it's peaked out and coming back down now. And that's about from December 2nd to December 28th, where we saw it really start to rise. So maybe we get one more high print, and then I'd expect this to crash back down into January. US probably will peak out in the next week. We can see the cases have gone up from 100,000 a day to 450,000 print. And we did just ship out, or we're going to ship out some 500 million test kits. So this likely will peak out in the next week, die down into January, and then it's game on for the reflation play that we're currently positioned for. We're seeing the rate of change peak up. This is happening about 2 weeks slower than I was predicting, but it is now happening. And this could be the ammunition for the Fed in January to be more dovish. Yeah, so a lot of people just want their account to go up every day. If it was that easy, everybody would just invest and get rich. In general, what we see with markets is they're really designed to give you pain and then have sudden jumps in value. And that's how the rich rob the poor. So yeah, just expect to see sudden jumps in return. And we got to have our line in the water, or you're not going to catch the fish. It's really that simple. Okay, so jobs data, we had weak job data last month. I believe it will be weak for the next 2 months and then start to pick up in February or March. This is what we need to slow down in the next 3 months. The CPI hit 4.9. Credit is growing from the banks. That's bullish in how we're positioned. Consumer credit continues to grow. Retail sales continue to grow. And again, with stock buybacks, we don't need retail to even grow, because they're going to reduce the number of shares outstanding and make that earnings per share go up. Consumer spending hit a new high last month. Job openings are at 11 million, so the risk of jobs coming back are there at least. Producer price index was trading flat for 3 months and then just jumped. So we really want to see that come down. So if this keeps going up, that's predicting the CPI will continue higher. Jobless claims are trading flat in this 200,000 range over the last 5 weeks. Wages are rising, not as fast as inflation, but this is going to keep that CPI going up. Salaries continue. Labor force, as you can see, is growing, but it's way below where we were in January. That represents about 4 million jobs that are gone, and it doesn't look like they're coming back. Now, this is not updated. From Trading Economics, the data just hit today. This hit a new world record, $96 billion trade deficit. So the way to predict the dollar is the twin deficits. If they continue to grow, the dollar tends to go down against other currencies. And that's exactly how we're positioned. And again, we just hit a $96 billion trade deficit, the worst in US history, the worst in any country's history ever. And so that's what happens when you give up all your jobs to the Chinese. And that's our position. So unless we get populism and break up the supply chains, we're really positioned well for what comes next. China's PMI has been slowing down, and they're starting to pump trillions of credit. But is China going to crash? I call BS. Their imports hit a new record high. Their currency is stronger than it's ever been. Their exports hit a new record high. As far as central bank balance sheets go, US just grew its balance sheet, coming in on $9 trillion. There's no slowdown like they said there was going to be. So that's curious. I'm not sure why they didn't slow it down like they said they would. Europe's continues to grow, didn't grow week over week, but has been growing rapidly. And now Japan just hit a new record high for its balance sheet. So the money printing continues despite all the rhetoric. There's that $97 billion trade deficit. Here's a look at NVIDIA's price to sales ratio, 31. If you got in 2008 after the crash, it was trading at 3 times sales. So that's gone up tenfold. Turkish Lira's 10-year yield hits 23%. This is causing pain. So bond rates going up anywhere are going to be a headwind against our tech positions and our cryptocurrencies. So if you're wondering why we keep seeing Bitcoin down in the morning and up in the day, look at this photo right here. Look at that 2-year on the US. Look at any bond that's tanking. That's going to start stealing fund from growth assets. Here's a big thread from One Bubble to Rule Them All, talking about the Japanese crash in the 90s. Interesting thread. Definitely worth reading. I won't read it all right here, but very good thread. And again, my Twitter handle is @GeneratesIncome. I post a lot of stuff that I don't read in the video just to keep the flow of the content quick. Essentially, he's saying it was due to extreme overvaluations and a mentality that Japan was just so much better than the rest of the world, and eventually overspending, over-indebted nation, overvalued real estate market, all led to the decline of their stock market and a multi-decade destruction of equity valuations in Japan. They're doing a lot better now, but he's obviously correlating that to the FANG stocks today. This is a look at the top ports in the world. Most are in China. If China is going to go crazy over the new variant and lock down the whole country, we're going to see commodity prices crush and PPI go up and CPI go up. So it'd be very, very bad for a lot of the ways we're positioned with NRGU particularly. So that's why I'm worried about China being crazy about this. And we'll look at a video in a minute. This chart from Grayscale Bot looks at the value of this trust relative to the price per share. You can get Bitcoin 19% off and Ethereum 12.5% off compared to going to Coinbase today. Now, will it get to zero or go to a premium? There's no guarantee of that. But typically, when these assets go higher, the discount shrinks. So you could very well likely outperform Bitcoin by at least 10% in the next move higher by owning GBTC instead of BTC. With Ethereum, the lowest discount I've seen it was around 5% in recent months. So you could potentially outperform real Ethereum by 7% in the next move higher. Massive long dollar position is built up this year, potentially a reversal coming through. And I believe this would be due to Build Back Better, reopening, and China really pumping their economy strong. So we'll see. This is looking at the margin debt, growing at the fastest pace on record. Again, what would pop that? Interest rates rising. They're not rising right now, so we're not worried about that. Most likely will go much higher, and that's been driving stocks higher. The Bank of China injects 190 billion yuan, second day in a row, so they are starting to get more aggressive. Here's the clip from China. That's crazy. These people were breaking the rules, so they put a mask on their heads, a picture of their face, and parading them through the city. It looks like 13 million people were locked down in China in one city because of 100 cases or something like that. So just to be worried about. Let's see. China's Xi'an enters 7th day. Residents are no longer allowed to leave to buy food. Samsung suspends operations at its local plant. So keeping a close eye on what's going out of China. China is also now hoarding energy, food, all sorts of commodities. So the question is why? And again, maybe they're just predicting food inflation next year and worried about feeding over a billion people. Kevin says maybe all countries are printing money and they'll keep the dollar up. Yeah, that would be fine as well. As long as currencies are being devalued and bonds are trading at low interest rates relative to inflation, we really don't want to change our positioning. Here's a look at the market weightings of tech versus energy. And you can see it's never been this far apart ever in history. So what we're basically predicting is going to happen is money's going to slowly take profit on tech, buy up the energy and banking sectors, and that this will work for a while. Interest rates will rise. I think they're going to rise towards 3% on the 30-year, and then we're going to have a chaotic event occur. And so look at what happened to blue, that's your energy, from 2000 to 2008. You can see interest rates rose that whole time, as we recall from earlier in the presentation. Energy went up 300%, and interest rates rose until it crashed the housing sector by 2006. Took 2 years of housing prices falling for all of a sudden everyone to realize something like a third of mortgages weren't getting paid, and you get the great financial crisis. So that's exactly what I'm believing is about to occur in slow motion. Not a big crash right now, growth to value first, and then interest rates eventually crash everything as they rise too high. So labor recovery of all things will be the problem for the stock market. This is predicting inflation slowing down in this chart, and that the Fed doesn't need to get so aggressive with rate hikes right now. So we'll see if that plays out. I do like to see when media, I know that's controlled by certain parties, changes point of view. So we had the Drudge suddenly coming after Fauci. We have the CDC suddenly changing all the rules. We had Bill Gates really changing his recommendation. So this is all leading me to believe that there's going to be a big push to reopen the economy next year and not be so crazy with lockdowns, mandates, and things of that nature. Okay, very good. So that does cover the news that's worthy. Oh, did everybody see the China video? Or did that cut out? Steven says he didn't see that. Yao says, is the triple Q a good hold and will it go high in the next year or two? So if it's in the trading plan, Yao, you know what to do. Jeff says he likes to sell high and buy low. Has had that problem for his whole trading career. Well, that's my main job, is to tell you when to worry about drawdown and when not to, because you know the market doesn't go straight up, otherwise everybody would be rich, right? Okay, so let's go back to this. So we're about to go into the content that's only for paid members. If you're watching this on an expired trial, you need to upgrade by calling John at 505-610-1334. So upgrade your free trial right now and get the trade alert so you know when to dump the tech, buy the energy, and then you'll know also when the Fed's going to ruin the party and crash everything, which will likely be due to inflation. Yeah, it looks like the clip from China didn't play. Yeah, they're just taking people out in these crazy white suits that covers their face with a picture of their face, and they're marching them through the square saying that these people broke the quarantine rules, is some sort of shaming and that they had locked down 13 million people who can now not even go to get food for the next 7 days. And the reason why we're worried about this is because that's where the supply chain begins. If they're going to go crazy with lockdowns throughout all of China because they can't control the new variant, that's going to be bad for commodities. So we'd want to get out of NRGU essentially if China's going to shut everything down. But it's also going to make the inflation go up, which would be bad, and it'd pressure the Fed to potentially hike rates faster, even though. So yeah, this is, we really don't want our manufacturing hub of the world to lock down, basically, for the way we're positioned. So keeping a close eye on that. And so they've locked down 13 million people out of 1.6 billion is nothing. So that's the good news on that front. Okay, so now we're going to go into